$45,000. Maintenance fee is $250 a month.
Why is this? Oh, it's 45% rate. We don't want that. That's a very high rate. That's much better. Let's say utilities is $150 a month. Insurance, $300 a month, and other expenses, let's say about $300 a month. Okay, so that's his rental property. Has a small cash flow profit a month of $347. And so here we have it. We have a property, a standard property, and we have a rental property. Let's go into the strategies. So these are the different strategies that we look at here at Smith Maneuver. So there's a whole variety of them. Let's just start with a simple, plain Jane Smith Maneuver. So just a really simple Smith Maneuver. And just a reminder at the beginning, you put a 53% marginal tax rate. Let's put 50. And 8% return. Okay, so let's go back.
And Ryan, before you do I'd like to, once you've gone through the analysis, could I add it on the plain Jane? I'm thinking I'd like to show them how to reduce the net cost of borrowing to zero. Could I just add a little bit of an element at the end of your analysis?
You can definitely add that, yeah.
So, you do the full thing, and then at the very end, after you do the cash flow dam integration, I'm going to add in just a little bit more.
Right. So in this current scenario, remember we were on 25 years or 30 years for his mortgage. So this is a standard mortgage. And remember, in all these strategies, one is the great thing that we try to explain is that none of the strategies increase the budget for the client. So the client was already paying $3,000 a month in his standard mortgage. He's going to continue to do that no matter what. This is a very important point because that's the point that Deloitte made in their research, that Canadians just don't have more money. So any strategy that involves them taking more money out of their pocket will probably not function that well because they're actually missing money on a monthly basis. So in this case, we're looking at the standard mortgage. Now, what we want to do is the Smith Maneuver invest all this amount slowly over time. So the deductible debt, this is deductible debt, the HELOC, so it gets reinvested. So the capital that is descending here gets reinvested. The non-deductible debt, this is the blue line. So now that we've paid off the debt, this is a standard debt. This debt is going to go down faster because the tax returns or tax savings are going to serve to pay down the non-deductible debt every year faster. And then finally, we have the investments. And so in this cash flow neutral scenario, what we're doing is that we're reinvesting the capital every single year over the period of the mortgage. So at the end of that same 30 years, without $1 more out of his pocket, in other words, he never serviced the interest on the HELOC. And if you're trying to figure out, well, how is that possible? It's because you're not accredited and you don't understand the mechanism. But essentially, they're not paying anything more than their normal mortgage payments. And at the end, they have a portfolio that is $1.458 million. They had a debt that didn't move over time, that stayed flat at $575,000. And so, their improved net worth is $883,146. So this is the basic, simple Smith Maneuver. Nick, you want to talk about the net zero principle?
Yeah. All right. So do me a favor. Hover over where it says investment portfolio, 1,458,000 in the box just above.
Yeah. Right there.
Okay. So
1,458,146.
Okay, now one thing this calculator doesn't factor in, guys, like that's the value of the portfolio, but what happens if you decide, let's say you get to the end of the 30 years, you've done this perfectly, you've got a massive portfolio, you've got a tax-deductible investment loan of $575,000. What if you sell the portfolio? You're going to pay capital gains tax. Now, there's a reason why we couldn't factor in capital gains tax into the calculator, which Ryan will explain in just a moment. But to do a sober net value, I got that from you, Ryan, I'm going to take 25% off the top. So if we go, oops, I pressed the wrong button. Give me that number again,
1,458,146.
So if I multiply that by 75% to get the net wealth improvement, or the wealth improvement net of capital gains tax is 1,093,000. But we're still carrying the tax deductible debt. So we now need to subtract 575,000 from that figure. And so the actual net wealth improvement for me in this case is 518,609. Now, Ryan, go to the regular mortgage, scroll to the bottom and show me the total interest cost over the whole amortization. Oh, look at that. Okay, 468,726 is the total interest cost over 30 years based on this scenario. Just doing the most basic version of the strategy, net of capital gains tax and net of paying out the converted debt, we've got a net wealth improvement that has exceeded the total cost of interest. And so look, again, no one's going to give you a 0% mortgage, but you can engineer it, provided you're prepared to look at this as long term. And the debt and the investment are interlinked for the whole time. They don't separate. They're essentially The investment is the other side of the debt, and it's there to counterbalance it. So
Really
we've
quickly,
shown you how to reduce your cost of borrowing to 0%.
Yeah, very good, Nick. Really quick, there's a question. Yeah, but how's going to monitor the investment? So this is where the SMCP community comes in, right? You guys are mortgage brokers. Whoops, I lost my screen. Give me a second. You guys are mortgage brokers, but in our community that we see here, we bring together all different professionals. So there's mortgage brokers, but there's financial planners, CPAs, realtors, all accredited individuals that connect on this portal and have a whole variety of services from marketing to social media posts every month and services, tools and integration tools, hundreds of them, compliance and conformity. I'm not going to go over this today, but that's all part of the services that we offer. Events, everyday coaching. From day to day, you can show up and get a live training as well as free webinars for clients that you can send to and get your unique links, landing pages, funnels, marketing and entrepreneur coaching. All this is available within one network, as well as other tools and other network partnerships that we're announcing as of July 1st. Essentially, every single advanced strategy network that exists in Canada will be available in one place, which is going to be here as of July 1st. There will not be any other that exists in Canada that won't be available through this network, period. That's give you a little hint on what's coming. That's already all signed. So yeah, I want to finish on this, but go ahead, Nick.
No, I was going to say, finish on the cash flow dam, because that's, for everyone in the room here, the cash flow dam is going to be one of the most relevant strategies for you, because the underlying investment is a rental property, and as mortgage professionals, we have clients that have rental properties, so it's very relevant for everyone here.
So they have, in this example, remember we had a rental property. If you go to general, we had this, mortgage information, we had this rental property that the client had. And so what we want to do is like, well, okay, well, I don't want to do the Smith maneuver, but I have a rental and I'd like to use that rental to convert my mortgage, my personal mortgage into a tax deductible debt and use that tax efficiency to pay down that mortgage faster. So what I've done here is I've gone into the accelerated strategies. I've chosen cash flow dam for a rental. And then I have to choose some data. So I'm going to assume that the rental increases are going to go up 2%. I'm going to stick to CPI data, 2% increase in expenses, 2% increase in the value of the property, as well as 2% vacancy. I like a 2-2-2-2 sort of strategy. You can always play around with it depending on what region you're in. And so that gives you the result. So if we put that in and we look at how that's going to look for a client, remember, same budget. In other words, the client is paying out of his pocket the same amount, so normally that would have taken 30 years, and paying the same thing, his entire debt in this scenario is paid in 17 years. So he's essentially saved 13 years of payments by simply paying the same thing. This is not a joke, this is math. Like this is not overblowing it or exaggerating. These are real numbers, they're trackable, defendable, CPA approved, period. So how that looks is that this is the converted debt. So the blue line is how long it will take to transfer the debt into a fully deductible mortgage. This is the deductible debt going up. So obviously this is at the same period because the total debt and deductible debt meet at the conversion point. And then once we've converted, we're using all that tax efficiency to return it to the mortgage and pay it off in record time. So essentially in this case, we've created a potential net worth improvement of $279,000 and a wealth opportunity. We call it a wealth opportunity, so we're being very clear on that. That the wealth opportunity, what this is what if I reinvested all the capital I would have had to pay from here to here? What if I invested that at an 8% return? Well, over the same 30-year period, using the same budget that I had, I would now have $969,000 in additional wealth. And I paid the same thing as I would have done just to pay off my mortgage. I did nothing differently from a budget perspective, and I now have close to $1 million in additional value. This is real numbers. Now, for people that don't have a rental property, really quickly, that doesn't, okay, everyone that's self-employed, so every mortgage broker that's not incorporated, every realtor that's not incorporated, but that has self-employed income, same thing. We can do, this is the same strategy. Let's say they have monthly expenses of $6,000 a month in expenses. That's $72,000 a year in expenses. Someone that makes $150,000, $200,000 a year makes about $60,000, $70,000 expenses. If I did the same strategy, just doing the same thinking with that, again, if I go to results, a person that just has a self-employed job that's not incorporated, I've essentially created $519,000 in additional wealth by just redirecting the flows of his expenses that he was normally using his commission to pay with. I've just redirected that flow to make it tax efficient, and I've saved that person 7 years on his mortgage. Same budget. So there's a lot of avatars.
The opportunity with like the sole proprietor, the various sole props. There's a CPA, like 15-year CPA with one of the big four, that I'm working on with the self-employed cash flow dam. That's one of the cash flow dam for rentals is kind of widely used, less so for the self-employed, but it's such a remarkable opportunity.
So, and there are other strategies as well that we coach on. So that's important. If you're a Manulife fan and you hear that strategy that they often talk about, the Manulife One strategy, but you don't understand it because you go on their calculator, you just plug things in and miraculously it gives you numbers and you can't actually see the numbers. Well, we decided to sort of like debunk that. And so if you wanted to do the power of the paycheck here, you would actually be able to design the whole budget and actually see month per month how that would work and why the client actually saves so much money using that strategy. So we coach on that, and obviously then you'll be able to give actually detailed reports to your client in order to how that works. So how this works in an N-sided network, because remember, we want to bring together natural networking, financial planners across the country, realtors across the country, all within one portal. So how that works is that you can share this. Once you've done it, you can share it with the client directly. He has a view only. Nick is a client, would have a view only. You send him that, and they can view all this in a live environment. In this same portal, and I'm going to finish with this, you can have implementation, show them how to implement. You have different lender guidelines, which is going to be improved. We have a new version being launched on July 1st. For if you're a mortgage broker looking to get every single guideline, norms of every single lender in Canada, this is going to be integrated into the portal. If you do a lot of rental grids, this is going to be machine learning. It's already been created. We already have it done. It's going to be integrated, all your rental grids for every single bank. You implement it, it connects in here, and it'll give you all the answers for all the qualifications of every single rental grid automatically. This is going to be integrated as of July 1st. Partners, if you have any investment advisors or partners, you can enter them and share all this information directly. Once they're in, you can share it, so you can share clients and analyze together. Summaries, you can film a video and actually present it to your clients. You can stop paying Loom every friggin' month and actually do it live within the portal. So basically, that's really quick my presentation of this calculator. I hope it was interesting.
That was a great demo. Thanks, Ryan. And I'm using this calculator every day. It's I love it. It literally replaces 4 calculators that I was previously using, and none of those calculators gave a holistic, accurate result that modeled any iteration of the variables. So thanks for doing that, Ryan.
Can I do one last thing for 10 seconds?
Yes.
All right, it's gonna be really quickly. And this is really nerdy, but follow me. Okay, it's gonna be fun. If you want to be really like nerd out a little bit, I'm doing some work with MIT in the States, and we one of the research we're doing is actually measuring what advanced or tax efficient mortgage planning looks like from a demand curve perspective in Canada. So how that looks, I just want to find this here. It's in here somewhere. That's the blockchain. Hold on a second. I'm in the wrong thing. I just want to show you the graph, what that looks like. I have it here. Okay. So that you guys understand, like, what is it? What does it do from an economic perspective when you look at these strategies? How does that work, like, from a supply and demand sort of perspective? And this is important to understand in like sort of economics. Is that why you want to understand this?
Sorry,
I want to really show this because it's really interesting. Sorry, Nick. That's what happens when I try to ad hoc and then I mess it all up.
It's all right.
अच्छा वो तो रफ पे बना देंगे एक
On
सेकंड
the word, okay, here it
आप
is.
कर लो खत्म फिर बना लेना
तेरा भेज दो बोलता
उसने ईमेल भेज दिया और पूछ रहे कि वाटर ब्लड
You should see
blood test थोड़ी
inside
prescription वगैरह
strategies.
कुछ दे देंगे
This is record. Yeah. So this is the standard demand curve. You know, everyone knows that. You did your economics course. You know, like demand, supply. So as like, clearly, you guys all know that if the rate is really high for a client, there's going to be obviously a very low demand for that, and if the rate is really low, there's going to be a high demand. Everyone agrees. This is the standard curve. So the lower your rate, because we're sort of in a from the consumer's perspective, unless we re-educate them, the lower the rate, the more they're going to request your services. Pretty straightforward. So what does that look when we actually integrate tax efficiency mortgages? Is that the actual demand curve becomes very, very, very elastic, or the original, it becomes like a horizontal line. And so what that means is that your price or your rate sensitivity almost falls off a cliff. And so this is really, really interesting from a data perspective, that your rate could be 4, 5, 6, 7%, and the demand is still as high because of the fact that you're demonstrating added value elsewhere. And so this is very, very interesting. And maybe you don't follow that, but this is for someone that's like looking at this from a scientific and like demand, like, is this viable in the future? This is very, very very, very good. So like we took the data, I used ChatGPT to create the graphics, but I found it pretty revealing. So anyway, that was my like nerd